There is this growing narrative among the Federal Reserve, even just with markets, that the Fed's going to have to speed up the pace of tapering. How is that going to react when it comes to risk assets in Asia? And do you think this is likely priced in already?
So I think overall, I wouldn't be too worried about the tapering, and to some extent, the point from the Fed in terms of keeping the flexibility with regards to the acceleration of tapering. Given where we are in terms of the economic rebound and inflation in the U.S., if anything, the Fed is a little bit behind the curve. Now, the question is obviously going to be around where do you see the normalization of policy from a rate hike perspective? And I do think some of that advancement will actually potentially cause three things. Some level of strength in the dollar, so further bid in the dollar, higher dispersion in the markets, and some pickup in the volatility in the market. So overall, even though I still believe the case for risk assets remains pretty strong, it can cause the short-term wobbles in the market as the markets look at the December data in terms of inflation and the payroll reports.
Given just the unprecedented move we've seen when it comes to prices and the inflationary pressures that we're seeing right now globally, Neeraj, how are you viewing returns on credit? How has inflation impacted returns?
So overall, inflation so far hasn't had that much of an impact on return on credit from a global perspective. The high yield or the investment grade in U.S. has been okay, more so the high yield, in fact. European high yield has somewhat underperformed the U.S. high yield, and Asia has significantly underperformed. But the underperformance in Asia is much more to do with the policy pivot and the regulatory tightening that we saw in China than anything else. So looking forward, I would say unless we see a significant shift in terms of the policy path and the U.S. dollar, I don't think that will be a meaningful driver for the credit returns. I still think the world is starved for income and yield. And I don't see too many other asset classes today from outside of credit which can actually provide you that income. And more so in Asia, you do have a large part of the markets, including dollar and the local markets, providing you that income. So I think it shouldn't be that impacted by the inflation outlook unless you see a significant runoff in inflation.
And we'll talk about China in the next segment, Neeraj, but I want to get your take on just ASEAN, where you are. There seems to be a lot of focus here on the reopening efforts in countries like Thailand. I'm just wondering, what does that mean from a credit perspective?
So overall, the reopening is something which is positive for these economies, specifically when you think about a country like Thailand, which has more than 10% of the GDP driven by the tourism pre-COVID. So certainly, it's a positive development from a macroeconomic perspective, similar for, I would say, rest of Southeast Asia. I think it basically keeps the policymakers a little more vigilant around the inflation aspect. But I don't think it has any negative impact on credit, given the growth is coming back, which is the positive tailwind for the credit markets.
We were talking maybe about a couple of days ago with other guests that perhaps we've seen the worst on junk bonds in China and high yield. Are you subscribing to that kind of view?
Overall, yes. And I would say we are on the path of recovery, though with a fatter tail. So I would not ignore either of the two, that there is potential recovery on the way with slight shift or pivot in the policy, the alternate sources of capital and the valuations where we are. But we still are seeing the risks out there with a fatter tail with the lower quality companies. So looking at the data and where we are, I think the cyclical bottom, which was a couple of weeks back around November 9th, is behind us. So we should see recovery, but it's not going to be the straight line that you saw in the last couple of weeks.
Do we have enough information at this point? I mean, I think a couple of weeks ago, we were still just, I guess, surprised and stunned by the amount of hidden debt that some of these developers do have. Are we getting more information? Are credit agencies giving enough guidance here on what separates the winners and losers and who actually has liquidity to navigate through this right now?
Sure. So first of all, I think there are always some surprises when you're looking at some of this data coming out in terms of the balance sheet. But in terms of the winners and losers, I would say it's a combination of three broad factors. Obviously, the first most important is the fundamental strength of the business. And obviously, that's based on the long-term fundamentals. The second is the liquidity or access to liquidity and the term structure of debt. And the third is the quality of corporate governance and management, who has then potential to find some access to liquidity in the next 3 to 6 months, because the pressure is still there from a liquidity standpoint on the smaller players. So you would still find some winners in the longer term. From a longer term perspective, these winners actually will generate significant return for investors, both on the credit and the equity side. But you do have the fat tail. So I think you overall still have to work through a framework of how do you map these different companies and go for diversified set of players who are potential survivor in the long term.
Yeah, beyond just the property space then, what are some winners, do you think? And what sectors are you focusing on in China, Neeraj?
So outside of that, we still like the higher quality investment grade credit in China. I think there the fundamentals are extremely strong. So a lot of the combination of state-owned enterprises as well as the private corporates. So I do think that provides a lot of value. China onshore credit market, which is a lot less of an explode market for foreign investors, continues to be attractive given the level of the inefficiencies in that market. We still like that. And then there are obviously pockets of value outside of China, which we are looking at closely.
And India, you're still watching that closely here. What are you looking at and what are you liking at the moment?
So in India, we do like the investment grade credit as well as selectively the high yield names. But in the onshore market, from a government bond perspective, we have been somewhat cautious for the last few months, driven by the inflationary impulse as well as the high commodity prices, and most specifically oil. And if we see a stabilization in oil price and the market pricing gets more aggressive in terms of the rate hikes from the RBI, I think there will be an interesting entry point in Indian onshore government bonds. But right now, we're still neutral on it.